What data is needed for stochastic volatility models? Have you ever wondered what goes into the complex world of stochastic volatility models? These models play a significant role in options trading, especially when it comes to understanding volatility. Let's break down the essential data needed for these models to work effectively. First, you need underlying asset price data. This is simply the historical prices of the stock or asset over time. This data is crucial because it helps model the price movements and infer how volatility behaves. Since volatility itself is not directly observable, the asset price data is the foundation for estimating the hidden volatility process. Next, you will requiring option market prices. These are the prices of standard options, including calls and puts, across various strikes and expiration dates. These prices reflected market expectations about future volatility. By using these option prices, you can calibrate the parameters of the stochastic volatility model, making it more accurate. Another important piece of data is the implied volatility surface. This surface is created from option prices and shows how market expectations of volatility change with different strikes and expiration dates. It provides a detailed view of market sentiment and is essential for calibrating the model to replicate observed volatility patterns. Additionally, you need to consider interest rates and dividends. The risk-free interest rate and dividend yields of the underlying asset are necessary inputs for pricing options. They affect how expected payoffs are discounted, which is vital for accurate pricing. While not always required, historical volatility estimates can be useful. This data is calculated from past asset price returns and can serve as a benchmark when estimating model parameters. However, stochastic volatility models primarily relying on market-implied data for their calculations. Lastly, for effective parameter estimation, you need data sets that allow you to estimate the parameters governing volatility dynamics. This includes factors like the mean reversion rate and the volatility of volatility. Techniques such as maximum likelihood estimation or filtering methods are often used to handle the hidden volatility process. In practice, traders and analysts use stochastic volatility models to price exotic options and manage risks more accurately. These models reflected the unpredictable nature of volatility and capture features like volatility clustering. By fitting the model to observed option prices and implied volatilities, traders can produce realistic option valuations and hedging strategies. In summary, to implement stochastic volatility models effectively, you will need a combination of underlying asset price data, option market prices, implied volatility surfaces, interest rates, and sometimes historical volatility data. These inputs are essential for estimating the unobservable volatility process and ensuring that option prices align with market observations.